All right, in this video, I'm going to walk through the tax benefits of a strategy called tax loss harvesting. Essentially, what it means is you're taking realized losses in stock sales or even cryptocurrency and using those losses to offset realized capital gains, right? So stocks that you sold at a gain, and you're kind of essentially kind of reducing your tax liability. Now, one of the benefits, and I'll show this to you first. So first, I'm going to go through a slide, and I'm going to show you a real life tax return example to kind of show you this benefit and tax savings. So just say you sold some stock, you sold, Peloton stock at a loss this year, right? 2022 was a bad year for the markets, but you didn't have any realized gains, right? You didn't sell any stocks at a gain. So what you can do is use up to $3,000 of these losses, and you can use that to offset other income, other ordinary income in your tax return. So anyways, I'm going to go through this example here. If you have any questions, leave them in the video link below, and we'll go from there. All right, so tax loss harvesting, what is it? Essentially, you're taking investments, right, like the stock sales that you have that are kind of in a loss position, and you just want to get out of it, right? So you sell it. So you got a realized loss. And then at the same time, you've had some realized gains. So you sold some stock and you made some money on these stocks, right? So it's taking the losses and applying it against the gains to kind of reduce the tax that you would incur. So just say you sold Apple stock, you got a gain, which is going to be subject to tax. Instead of paying the tax on the Apple stock, you have some losses here. So why not sell some of these losses that that aren't going to be performing well in the future? So you're going to kind of offset that. And I'll show this to you in an example in a tax return. So that's kind of essentially what it is. And especially in the year 2022 here, the market hasn't been doing well. There's been a lot of stocks that have been performing poorly. So you might have some losses, some stocks that you're holding that are in a loss position. Why don't you just sell that? Now you have this loss that you can kind of utilize against other gains. Now, what if you have no gains to offset those losses with? Well, you can use up to $3,000 of losses from your stock sales to offset other income on your tax return. Again, I'm going to show this to you in an example of a tax return so you can kind of visualize what this looks like. Now, keep in mind when you take advantage of this tax loss harvesting rule is there's three things to kind of keep in mind here. So first one is the wash sale rule. I'm not going to go into detail of the wash sale rule. There's another video that I created that kind of walks through this. But essentially, if you sold the stock, just say on October 1st, right, Peloton, for example, and you sold it as a loss, and then you decide to buy it back within 30 days, the loss that you incurred there, you can't use, okay? So keep that in mind. So just make sure that when you sell these securities, so don't go out and start selling all these things at a loss. You got to look at your overall big picture here and what your investment plan is, right? So, you think of like Peloton hasn't been performing well, and maybe that's the type of stock that you want to get out of, right? Or maybe it's the industry that you want to get out of and you want to move into more technology based. So in that case, you're not going to buy back Peloton. So, that might be, a reason to kind of sell it, right? And you won't be stuck in this wash sale rule. Next thing to consider is long-term versus long-term and short-term versus short-term. So short-term is any securities that you buy and sell within 12 months, so within a year. Long-term is when you buy and sell stuff greater than a year. So example of a long-term would be you buy Apple stock in 2020 and you sell it in 2022, right? So that's greater than a year. Just say you bought and sold Peloton, you bought it in January 2022 and you sold it in October 2022. That's considered short-term. So with this whole tax loss harvesting, with what I'm kind of drawn to here with this long-term, short-term is if you have a long-term gain and you have a long-term loss, right? And then you have a short-term gain, right? if the short-term loss that you have to first apply it to the long-term gain, okay? And then once you use that up, then you can potentially apply it against the short term. So you can't like, I got this loss here, I got a gain, and I got a gain here. I'm going to use my loss against this gain. No, you can't do that. You first got to apply it to the long term in this example. Next is tax deferred accounts like 401ks, Roth IRAs. You can't use this tax loss harvesting in those type of retirement accounts. So let's move to a tax return example. And if you see my other videos, here we got Ferris and Sloan, married filed joint return. 2021, we don't have the 2022 return as the making of this video. And let's see here. They have a tax liability, a tax due to the IRS of about $11,143. So keep this in mind, okay? So that's shown on page 2 of the 1040. And then if you look here, right, capital gain, it's 0, okay? So now let's use this as an example, and we're going to kind of fill in the blanks here. So Ferris, right, he bought Peloton for $25,000, okay? And he bought it back in 2020. It was the start of the pandemic. He's like, everyone's going to be, buying these bikes. They're going to be working from home. They're going to be exercising from home. They're not going to go to the gym anymore. So he said, okay, this is a great investment. Well, 2022 comes around and the stock's tanking, right? He's like, I got to get out of here. This is not a good investment for me, right? So he sells it for $10,000, okay? So he's got a loss here of $15,000, right? You take what he bought it for, what he sold it for. So he got this cash, but now he's got a realized loss of $15,000. And by the way, this is long term, right? So he bought it in 2020. He sold it in 2021. It's greater than 12 months. So this is long term. Apple, he buys this in 2017, right? And he needs some money right now. They're making some improvements to their home. So he wants to sell Apple. Okay. And that's why he sold it, right? He still likes the stock, but he needs the money because they're doing some renovations on the house. So in this example here, he's got a $7,000 realized gain, right? Long term, right? Because it's greater than a year. So he bought it for $1,000, sold it for $8,000. So he's got a gain of $7,000. Now, if we didn't have this Peloton, he'd be having to pay tax on the $7,000, okay? But he's saying, you know what? I want to get out of Peloton, but I'm also I want to reduce my tax liability here. So what he does is he sells Peloton. Okay. So now let's go to page 1 of his tax return and let's see the impact of this. So you kind of look at the bottom here, the net impact, he's got a loss of $8,000, right? So he spent $26,000 buying these two securities and he sold them. So he got cash of $18,000, but his sales price is a lot less than the cost basis. So, and the difference is $8,000. Okay. So let's go back to page 1 and let's look at that line, the capital gain. So line 7. Now you see here, it's $3,000, right? So that Peloton loss, right, of $15,000 wipes out the gain from his Apple stock, but you can only, the limit of the loss per year that you could deduct on your tax return is $3,000. So he's got other income, right? He's got salaries and wages. So he gets to use up to $3,000 here to offset that $150,000, right? Which is a good thing, right? Because remember, he's got $8,000 of losses and he can use up to $3,000 to offset this other income that he has. So if you remember, his tax liability was, remember, it was like $11,147. Now, by doing, the sale of Peloton and the sale of Apple and that loss that he created, now his tax liability to the IRS is $10,000. because he was able to utilize up to $3,000 of losses. So, that's about, I don't know, $800 or so of tax savings there by selling those securities. Now you might think, wait, he had $8,000 of losses, of combined losses. What happens? We used $3,000 this year. What happens to the other $5,000? Well, that gets carried forward to next year in 2022. So if he doesn't do anything, if he doesn't sell any stock or anything else, he can use up to $3,000 of this $5,000 to offset income that he has in 2022, like other wages. So this is the whole tax loss harvesting. It's a tax strategy. What I recommend though is you don't want to go out and just start selling stocks. You want to look at your total investment strategy. And that's where I'm a huge supporter of kind of using investment advisors if you're not, if you don't know what you're doing, because these are professionals, they know what they're doing. So here it is. Now, if he doesn't, so he needs the money to do the home renovation, right? The $8,000, but he still picked up $10,000 here at Peloton. So if he doesn't need the $10,000, what he could do is, if he's interested in technology stocks, is he can go ahead, because stocks right now are very low. He can go ahead and buy $10,000 worth of Amazon stock if he wants to do that, right? So yeah, he takes a loss here. That loss, is an advantage on his personal tax return, but then he can kind of use these funds to buy something else that will probably kind of grow at some point. So anyways, this is the tax loss harvesting tax strategy.